Do you want to generate $20,000 in gains with $40,000? Do you want to achieve a 50% return on equity? Do you want the mathematical weapon the wealthy use? The answer is simple. Understand leverage. Use the bank's money. Why does it work? This slide explains it all. Consider a $200,000 real estate property. $40,000 down payment, $160,000 loan. 80% LTV. The property value increases 10%. It becomes $220,000. Your appreciation gain, $20,000. That's a 50% ROI on your $40,000 equity. What if you bought the same property with $200,000 all cash? Same 10% increase, $20,000 appreciation gain. But the ROI is 10%. Compare that to 50% with leverage. That's a 5x difference. This mathematically amplifies your equity ROI on the upside. On the other hand, downside risks like price drops, rising rates, vacancies, and maintenance costs also amplify losses and bankruptcy risk. So results heavily depend on market conditions and how you manage it. And this is achievable depending on conditions. Build your credit score high. Calculate your cash flow using the actual interest rate offered to you. This changes your capital efficiency. Today, let me show you the mathematical proof. Not all debt is bad. Do you understand this? The wealthy know. There are two types of debt: good debt and bad debt. Good debt generates assets. Consider a real estate investment loan. What matters is whether rental income, after deducting operating expenses, still exceeds your debt payments. After taxes, insurance, repairs, management fees, and vacancy costs, cash flow is positive. This is good debt. Business expansion loans are the same. If ROI exceeds the interest rate, borrowed money makes money. On the other hand, bad debt generates nothing. High-interest credit cards. Over 20% APR is not uncommon. From 2024 to 2025, average APR has risen even higher. Always check the APR on your card statement. You buy appliances with this. Assets don't increase. Only interest increases. Car loans are the same. The value drops 20% the moment you buy it. This is bad debt. The wealthy buy assets with good debt. Average people consume with bad debt. This difference determines your wealth in 10-20 years. Which do you choose? If you use leverage, optimize your loan terms. There are three elements. First, LTV, loan to value ratio. Aim for 80%. For a $200,000 property, $40,000 down payment, $160,000 loan. With 20% equity, you secure sufficient leverage while theoretically maintaining collateral to debt balance, even if property value drops 20%. However, when you factor in acquisition and sale costs, even a drop under 20% can put you in the red. Second, interest rate. This is critical. Interest rates vary significantly by market phase. From 2024 to 2025, 30-year fixed rates have been mostly in the 6% to 7% range. Investment property rates are 0.5% to 1.0% higher than that. 6.5% to 7.5% is the realistic range. 4% was the ideal from the past low-rate era and should be your future refinancing target. So don't assume 4%. Always recalculate DSCR and cash flow with the rate actually offered to you. Credit score matters, but the threshold for best terms varies by product, lender, and scoring model. As a guideline, maintain a high score range and confirm with quotes. Third, term. Choose a 30-year fixed rate. Variable rates are dangerous. If rates rise, so do your payments. Fixed rates are predictable. Additionally, fixed-rate debt can see reduced real burden under inflation, but insurance, taxes, and repairs can also rise. You need to check both sides, income and expenses. Understand these three conditions. Calculate with market reality. This is your leverage benchmark. If you use leverage, understand DSCR, debt service coverage ratio. What is it? Annual net operating income divided by annual debt payments. What matters is using net operating income, NOI, rental income minus taxes, insurance, management fees, repairs, and vacancy costs. Let's calculate. $2, $800 monthly rent, $33, $600 annually. Consider operating expenses, taxes, insurance, management, repairs, vacancy reserve. Let's assume $9, $600 annually total. NOI is $24,000. $1, $600 monthly payment. $19, $200 annually. $24,000 divided by $19, $200. DSCR of 1.25. Banks look at this number. DSCR standards vary by lender, product, and property, but 1.20 to 1.30 is often required as a guideline. Always confirm with your financial institution's terms. Why does this benchmark matter? Rental income exceeds debt payments by 25%. This is your safety margin. You might have vacancies. You might have repair costs. In recent years especially, insurance premiums and property taxes have surged dramatically. Always incorporate the latest insurance quotes into your DSCR calculation. Don't use old numbers. With DSCR of 1.25, you can handle these risks. Below 1.0? Dangerous. Rent is below debt payments. You're losing money every month. This is not an investment. Calculate your DSCR. Always include operating expenses. Secure 1.25 or higher. This is the key to using leverage safely. Leverage is a double-edged sword. Never forget this. It amplifies gains, but it also amplifies losses. Consider the same example. $200,000 property, $40,000 down, $160,000 loan. Property value increases 10%, $20,000 appreciation gain, 50% ROI. Excellent. But what if property value drops 10%? It becomes $180,000. Your loss, $20,000. That's 50% of your $40,000 equity. Half is gone. What if you invested $200,000 all cash? Same 10% drop, $20,000 loss. But ROI is minus 10%. With leverage, it becomes minus 50%. This is the double-edged sword. And there's something even more important. Looking at price appreciation alone, equity ROI can be 5x higher. But judge based on total returns including interest, operating expenses, taxes, and sale costs. Appreciation gains are only realized when you sell. At sale, brokerage fees, capital gains tax, and closing costs reduce your net profit. This is why risk management is critical. Understand market cycles. Analyze the area. Have an exit strategy. Rents don't always keep rising. There are periods like 2024 when oversupply causes stagnation. Conservative estimates are essential. Leverage is a tool. Depending on how you use it, you can build wealth or go bankrupt. So how do you use leverage safely? There are 5 principles. Principle 1. Maintain your credit score in the high range. This is the foundation for securing favorable terms. However, for investment loans, the property's income-generating ability itself may be weighted more heavily. Principle 2. Secure DSCR of 1.25 or higher. Net operating income, after deducting operating expenses from rental income, exceeds debt payments by 25%. This is cash flow safety. And what's critical is calculating using the latest insurance premiums, taxes, and management fees. Not past numbers. Today's numbers. Principle 3. Keep LTV at 80% or below. 20% or more equity. Theoretically, even if property value drops 20%, collateral value and remaining debt balance out. However, when you factor in acquisition and sale costs, actual margin is smaller. Principle 4. Choose a 30-year fixed rate. Your payments are locked in. Fixed-rate debt can see reduced real burden under inflation, but insurance, taxes, and repairs can also rise. Check both sides. Principle 5. Secure 6 months of emergency funds. You might have vacancies. You might have repair costs. Insurance premiums might surge. With this fund, you avoid panic selling. Follow these 5 principles. Leverage becomes your ally. Ignore them, it becomes your enemy. How do the wealthy use leverage? There are 3 philosophies. Philosophy 1. Don't use your own money. Use the bank's money. Even if you have $200,000 cash, invest only $40,000 and borrow $160,000 from the bank. Keep the remaining $160,000 as liquidity. Save it for the next opportunity. However, at purchase, expect closing costs of about 2% to 5% of property price, recording fees, loan fees, title insurance. Initial investment isn't just the down payment. Be prepared. Philosophy 2. Diversify. Instead of $200,000 all in one property, invest $40,000 each in 5 properties. With $200,000 equity, you control $1 million in assets. Risk is also diversified. However, verify profitability for each property. Currently, finding properties that yield 1% of property price in monthly rent is difficult. In many markets, rent-to-price ratio is around 0.5% to 0.7%. Calculate with realistic numbers. Philosophy 3. Prioritize cash flow above all. Not paper gains. Net income after deducting operating expenses from monthly rental income. DSCR of 1.25 or higher. Rent exceeds operating expenses and debt payments. This is the path to financial freedom. The wealthy think this way. Don't use your own money. Use the bank's money. Diversify. Secure cash flow after operating expenses. This is the philosophy of leverage. Now, let's organize today's key points. Here's today's summary. First, the mathematical power of leverage. Buy a $200,000 property with $40,000 down. If property value increases 10%, appreciation gain is $20,000. Equity ROI of 50%. Buy all cash, and the same $20,000 appreciation gain yields 10% ROI. Looking at price appreciation alone, leverage amplifies capital efficiency 5x. But this is about appreciation gains. Judge based on total returns, including interest, operating expenses, taxes, and sale costs. Appreciation gains are only realized upon sale, and brokerage, taxes, and costs reduce net profit. Second, distinguish good debt from bad debt. Good debt generates assets. Real estate investment loans, business expansion capital. What matters is whether rental income, after deducting operating expenses, still exceeds debt payments. After taxes, insurance, repairs, management fees, and vacancy costs, cash flow is positive. This accelerates wealth. Bad debt generates consumption. High-interest credit cards, over 20% APR, is not uncommon. Depreciating car loans. This pushes financial freedom further away. Third, safe leverage in practice. DSCR divides net operating income, NOI, by annual debt service. Secure 1.25 or higher. Standards vary by lender and product, but 1.20 to 1.30 is the guideline. Maintain high credit score. Keep LTV at 80% or below to avoid negative equity risk. Make payments predictable with 30-year fixed rate. Prepare for contingencies with 6 months emergency fund. And what's critical is reflecting the latest insurance premiums and taxes, not past numbers. Today's numbers. These principles make leverage your ally. Will you buy assets with just your $40,000? Or will you use the bank's money and acquire $200,000 in assets? What's your leverage strategy? Share in the comments. Your investment plans, your questions, your success stories. All of it becomes wisdom for this community. Thanks for investing your time with me today. This channel breaks down leverage, asset allocation, and cash flow strategies with numbers. The mathematical weapons the wealthy use, you can have them too. Subscribe to the channel and get even deeper insights in the next video. Until next time, keep building.